morning, and thank you for joining today's webinar for an in-depth discussion on what lies ahead for the national and local economies for the remainder of the year. My name is Adam Goldstein, the Chief Business Officer at the Federal Home Loan Bank, and today we're featuring our financial economist, Brian Jones. Before we turn it over to Brian, I'd like to highlight a few things for you today, this morning. First, just a reminder that we are celebrating our 90th anniversary on July 22nd, 1932. Herbert Hoover signed a bill for the Federal Home Loan Banks to be born, and away we went. Our membership and our mission has evolved to meet the needs of the market, and our defining principle for 90 years has and remains stability. The underlying strength of the Home Loan Bank comes from our cooperative structure. We are both owned by and a partner to you, our members. You trust us with your capital, you rely on us for funding on demand, and together we work to raise up the communities that we all serve. It is this partnership that has kept our system such a vital and reliable part of the economy for the past 9 decades. And for 90 years, our members have had a stable partner in the Home Loan Bank, and our entire team is focused on ensuring that you always will. And with that, I'd love to turn it over to Tom Citino, Director of Member Relations, to introduce Brian. Tom, take it away.
Hey, thanks, Adam. Good morning, everyone. So it's a real pleasure for me to introduce Brian Jones. He's been at our bank for over 5 years now, and he does a lot of speaking engagements. He meets with a lot of board of directors and management teams, but he's well received by our members, and we're really happy to have him. We did not have a financial economist prior to Brian, or at least in recent history. But Brian's position now, he provides macroeconomic analysis and strategic insights, which are used across all areas of our organization. Prior to working at the bank, Brian worked at some other leading domestic and foreign institutions, which included Societe Generale, Citibank, Solomon Smith Barney, Lloyds Bank, and then also he worked at Urban Trust back in the day. And throughout his career, he supported all aspects of the fixed income, currencies, and commodities businesses of his prior employers with regards to U.S. macroeconomic analysis and forecasting. So, Brian, with that, I'm going to turn it over to you to start the webinar. So, Brian, take it away.
Good morning, everybody. With the Federal Reserve embarking on what's likely to prove the most aggressive tightening cycle in decades in response to the recent flare-up in consumer price inflation, fears of an impending recession have grown over the past several months, and there's a good reason for that. If you look at what's happened to the U.S. economy since the end of the First World War, we've had a variety of recessions, but over half of them since the Second World War have been attributable to overly aggressive monetary policy. The last 3 recessions that we've been involved in were not caused by policy. The last one was obviously the shortest in our history, just 2 months long, and that was due to the healthcare crisis. Before that, we had the largest recession since the Great Depression, and that was the financial crisis of 08-09 that was triggered by the mortgage financing problems. But for the most part, if you look back at our history, it's monetary policy that throws us over the cliff and ends business cycle expansions badly. Just as a rule of thumb, the thing to bear in mind here is that since the end of this First World War, we've had 9 recessions that we can basically lay at the feet of monetary policy, and on average, they've lasted about a year. So that's just a little bit short of what the average is across all various causes. The important thing, I think, where we are now is that there are 2 distinct things that we need to bear in mind. There's 2 questions that you need to ask. The first is, are we in a recession now, or will we be in a recession anytime in the immediate future? The answer to the first question, despite the fact that we had 2 consecutive quarters of modestly lower GDP growth, is all indicators right now pretty much are that we are not in a recession. I know that the 2 quarters of negative growth is a convenient rule of thumb that people use when they try to gauge whether or not expansions come to the end. But the National Bureau of Economic Research, the economists on their business cycle dating committee, they use a much broader brush when they determine whether or not we've entered a recession. And basically, it comes down to what we call the 3 Ds. the depth of the business cycle downturn, the duration of it, and its diffusion. And by diffusion, we mean how spread out it is across various segments of the economy. Now, not all of those factors are weighted equally in any given call. For example, if you look at the last recession we had, it was just 2 months long, so the duration was very short. But the breadth of the downturn and its magnitude was massive. If you look, one of the reasons why I think you've got to be careful with the 2 consecutive quarters of negative growth rule of thumb. And you can see that in the right-hand side panel here is there are 2 ways of estimating aggregate economic activity in the United States. We can use real GDP, gross domestic product, or we call that the product side, or we can look at aggregate activity using the income side, looking at figures on real gross domestic income. Now, we don't have second quarter figures available for real GDI yet, but as you can see in that chart on the right-hand side panel here, GDI has been running well above GDP over the past several quarters. And in fact, right now we have a record gap or a record what we call statistical discrepancy between these 2 concepts. Now, every year the GDP figures for the last 3 to 5 years get revised at the end of September, and more often than not, that gap gets closed by the GDP figures moving closer to gross domestic income. And the reason being is, if you think about it, the income statistics tend to be more reliable because you're taxed on income. And people are not going to report income they don't have and get taxed on it. So that's why I think there's probably a potential that you might see these 2 negative quarters of growth washed away on revision at the end of next month. If you look at what's going on in the economy right now, there's no indicators that we're in a recession. I mean, the most important thing for the U.S. economy is the labor market. And in order, basically because 70% of economic activity in this country is determined by consumer spending, in order to really curb consumer spending, you kind of have to take a hatchet to labor market conditions. And the rule of thumb that I like, and it was developed by a former Fed economist, Claudia Sam, is you want to look at the unemployment rate over a 3-month period relative to its low over the prior 12 months. And in order to basically signal a business cycle downturn, you need the current unemployment rate over the latest 3 months to move a 0.5 percentage point above the prior low. And right now, we are nowhere near that. In fact, in order for that indicator to signal that we're in a business cycle downturn, we need to see the unemployment rate climb to above 4%. If you look at the right-hand side panel here, there's another model that I think is probably very useful to look at, and it's developed by the Federal Reserve Bank of St. Louis, their smooth recession probability model. And it tries to basically mimic the thinking that goes into the National Bureau of Economic Research's thoughts on dating business cycles. And it's basically 4 series: non-farm payrolls, industrial production, real personal income less transfer payments, and real manufacturing and trade sales. Their latest data just came out for the month of June, and they placed the probability that we're actually in a downturn 2 months ago at just 1.7%. Another model that I like to look at is one that was developed by the New York Fed, and it relies on the slope of the yield curve between 3-month Treasury bills and 10-year Treasury notes. Now, their latest figure is for the month of June, and it put the probability of a recession 12 months ahead at just at 5.9%. We are, however, given that the gap is closed between the yields on those 2 maturities, if you estimate it right now with the data that we have in hand, the probability of recession by August of next year actually climbs to about 25%, a little bit above 25%. What's important here is that all of our future recession probability numbers are moving in the same direction. I think that's the lesson to take from all of these. The quick conclusion is that we're not in a recession currently, but all of our future recession probability measures are climbing alarmingly higher. On this next panel of charts here, we've got a series of recession probability models that have been developed by Bloomberg Securities. One that's I think is worth noting is that the spread between 2 and 10-year notes. They've been inverted for quite some time. Bloomberg's last official estimate of whether or not we were going to be in a recession 12 months from now, based on that spread, was about 37%. If you make back of the envelope adjustments for where we are right now, the probability that we'll be in a business cycle downturn within the next 12 months is about 56%. If you look at other models that they've developed that are based on a wider array of economic variables, they place the probability that we'll be contracting in a meaningful way at about 1/3% over the next 12 months. And more alarmingly, they have the probability of recession over the next 2 years at 100%. So they expect us to enter a business cycle downturn over the next 2-year period. Now, on the right-hand side panel here, we've got a recently developed model for the Federal Reserve Board. Now, these data is through the first quarter of this year, but essentially their results corroborate those of the Bloomberg survey. Their model puts the probability of recession by next winter at about 50%, a little bit over 50%, but 2 years out at almost 2/3%. So the takeaway here is that we're not in a recession right now, but pretty much every model that we can construct is saying that we're going to be in a business cycle downturn within the next year or two. Turning to what's actually going on in the economy right now, the labor market, which is the key for us, remains extremely strong. Hiring was solid in the month of June. We created almost 375,000 jobs. We're probably going to find out tomorrow morning that we created another 300,000 plus jobs. So there's really no change in net hiring within the economy. And within the June report, we actually finally got back all of the private sector jobs that we had lost as a result of the healthcare crisis. There are still some industries that are struggling, like leisure and hospitality and education and health, but there's also a lot of segments in the economy where employment right now is above the pre-pandemic levels. Looking at the breadth of hiring, and that's what these indexes do here, these diffusion indexes, they measure the hiring across industries over 1, 3, and 6 month spans. The breadth of hiring across industries is extremely solid and near historical highs as of the latest report. These measures are important because if you think about it, what would you rather have? Would you rather have one firm hire 100 employees or have 10 firms hire 10 employees? You'd probably rather have the latter, because even though the net job growth is the same, it's more spread out across segments of the economy. Looking at the unemployment rate, we've been stubbornly stuck at 3.6% for the past 4 months. We'll probably remain near that level in tomorrow's report. The extended unemployment rate, however, that includes the marginally attached workers and those that are working part-time for economic reasons, we hit an all-time low with the June report of 6.7%. So whether we look at the payroll numbers or we look at the household survey that we get the unemployment rate numbers from, both of those surveys are very strong. And against that backdrop, wage gains have been really solid over the last 12 months. And essentially what's going on here is in a lot of areas, the demand for work is outstripping supply. And you can see in the left-hand side panel here, the place where we've actually had the most explosive wage gains have been in leisure and hospitality, where we've had the toughest time getting back to where we were before the healthcare crisis began. As of the data that came out this week, even though the total number of job openings were down from the prior month by about 600,000, there's still a gap of about 4.8 million between the number of job openings out there and the unemployed persons. Put more in easier terms to get our arms around, there are essentially 1.8 jobs out there for every unemployed person. Our area, we're doing okay. We're not doing as good as the remainder of the country, and you'll see that in a lot of the forthcoming slides. Our gap as of May, because that's the latest data that we have, was almost 250,000. So about 1.4 jobs per unemployed person across the states of New York and New Jersey. Turning to the other part of the Fed's mandate, this is the one they're having the most problems with. They've certainly achieved their goal on the employment side of the dual mandate. It's the inflation side. Inflation continues to be a problem, although we may get some relief in the upcoming report because of weaker gasoline prices, a pullback in airline fares, and lower automotive prices. But you can see that given the recent experience where we've had these surges in prices over the past 12 months, it's going to take the Fed a while before they get inflation, whether we use the core CPI measure or the core PC deflator measure, even close within to the 2% target. We've got a long way to go there. And these numbers on the right-hand side panel here assume that the Fed is right in their forecast that they've provided for the next several years. The problem with the inflation that we're going through right now, and we're up about a little over 9% on the CPI over the latest 12 months reported, is that the Fed has very little control over a lot of these areas. A lot of the increases in prices that we've seen have been due to excess demand because of fiscal stimulus, overly lax monetary policy, but also we've got segments where there are particular problems. The energy prices increases, which have contributed about a third of the overall jump in the CPI, that's been made worse by Russia's war in Ukraine. I think we can move beyond calling it a conflict. It's an outright war. And so that's had a severe impact on energy prices, although we may get some relief in the report due out next week. Other areas where we've had problems, and this is more a function of supply chain problems, is the automotive sector because of chip shortages. But other areas, the price increases, they're demand-driven, especially when we look at services less energy. Shelter costs are going up because basically, price of homes are going up, rental fees are going up, airline fares have been a problem as well. So there are some areas that the Fed has control over, some they don't. If you fear about it, monetary policy tends to be a very blunt instrument, and its job basically is to rein in excess aggregate demand. In some sense, some of the Fed's job is being done by financial conditions. Financial conditions have gotten better since the middle of June as of this morning, but they remain restrictive relative to historical norms. You can see that in this pair of exhibits here, that even though, for example, money market spreads have come in, bond market, stock market volatility have been reduced, and equity prices have done better, we're still below the break-even line of zero. So financial conditions are still a headwind, even though they've eased a bit in the last 8 weeks. Looking at interest rates have changed dramatically since the middle of June. Basically, certainly the shorter end of the Treasury yield curve has moved up along with the Fed's tightening. But basically, we've seen coupon issues from 2-year notes out. Those yields have come down dramatically. Basically, if you look at the various portions of the yield curve since the middle of June, the gap between 2-year notes and 3-month bills has collapsed by 89 basis points. That should read 65 basis points there. There's a typo there. The 2-10 spread, and this is something that's followed closely by market participants as a gauge of potential recession. We've gone from a positive gap of 8 basis points to an inversion of 38. Since the middle of June, and we've had an inversion from 2s to the 30-year bond as well. So basically, what the yield curve is telling you is that one of two things: either the Fed's going to be successful in reining in inflation, or there's going to be a recession, or some combination thereof. And you can see that in this next series of charts here. Market pricing of what the Fed needs to do up until the early January 24 meeting is certainly at variance with the guidance the policymakers have given us in their last dot plot. Basically, the last Fed official forecast called for continued tightenings through this year, further 0.3 of a percentage point hike in the funds rate target next year before flattening out. The markets right now, they're not buying that. Market pricing is that the Fed will probably be finished sometime in the winter, whether at the February or the March meeting next year, and then from that point on, we'll probably get reductions in the federal funds rate. And that's implicit within that graph on the right-hand side, is that the markets expect the Fed to basically put the economy into recession. Unlike the Bank of England, who this morning said after their aggressive tightening move that they think that they're headed into a recession that's going to last somewhere around 15 to 18 months. The Federal Reserve, I don't think you'll see them call for a recession until we're actually in it. And these are their latest forecasts here. Basically, what they're assuming is that we're going to have near trend growth this year, next year, and into 24. They do think that the unemployment rate edge higher, but again, it's going to remain below what most people would consider full employment. They do think that they are going to be fairly successful in a fairly brief amount of time in getting inflation down. If you look at overall inflation, they think it's going to clock in at about 5.2% over calendar 22, and that they'll be able to rein it into 2.6% next year, and they'll be pretty close to target by 24. And it's similar for the core PCE inflation gauge if we strip out food and energy prices. Looking at these numbers, I'm going to have to take another look at because the CBO just came out with the new estimates of the projected federal budget deficits based on the latest fiscal stimulus plan. But in the last CBO forecast, they did take another look at their longer-term deficit estimates. They expected basically where we are now in proposed programs before the latest package to increase the deficit over the 2023 to 27 period by about $1.5 trillion, and over the next decade by almost $4 trillion. Against that backdrop, what's important is that it's going to require a boatload of issuance of Treasury securities over the next decade. Essentially, what's going to happen is the amount of debt held by the public is probably going to top the $50 trillion mark by the year 2032. It will probably be somewhere around somewhere north of, it will be about 110% of nominal GDP. So again, that's something to bear in mind, and this is a much longer term thing to consider. As far as the banking sector, and we did get recent data out just this week on what bank lending offices are seeing across a variety of loan categories. Essentially, banks in the second quarter, they tightened lending standards across the whole spectrum of loans, whether it's consumer loans, business loans. Across the board, conditions tightened. And looking ahead, senior lending offices were asked what they expect for the balance of this year, and almost universally they're looking for further tightening in lending standards. Now, things are a little bit mixed when you look at the demand side. Loan offices did report both increased borrowing demand across both large and medium firms for C&I loans. You can see that in the upper right-hand side panel in this selection of charts. However, when you look at commercial real estate loans, basically they've been seeing declining demand for construction and land development and non-farm, non-residential. Multifamily loans continue to expand. That's one area, and we'll see this in other charts upcoming. That seems to be an area of increased, a very strong demand right now. Turning to consumer loans. Basically, the net percentage of banks tightening mortgage standards is essentially been flat in the second quarter, amid weakening demand across all loan categories. On consumer loans, there wasn't much change in lending standards. However, we need to bear in mind that 2 of the 3 lending categories were growing as of the second quarter. That was credit cards and other consumer loans. Automotive loans, probably because of the shortage of vehicles on lots and pricing. Auto loan demand has remained somewhat weak. Looking at our area closer to home, things are very mixed across our district, which is New York, New Jersey, Puerto Rico, and the Virgin Islands. As far as manufacturing in New York State, manufacturing improved in July, moving back into positive territory. But firms are a lot less optimistic about conditions in the future. In fact, most manufacturers in our area, they're essentially agnostic about where conditions will be 6 months hence. Turning to the service producing side, and this is more alarming considering that about 85% of our activities are concentrated in with those firms. Service producing activity, at least in our area, contracted in early July. The ISM's numbers out yesterday that were the national figures. They actually showed a pickup in activity, which obviously it bypassed our district. And looking at firms' expectations for the next 6 months, like manufacturers, they're very guarded in their assessments of what business activity will be like 6 months hence, and they remain very negative about the future operating climate by the end of this year. Whenever you look at an economy that's so concentrated in service-producing industries and relies so heavily on consumer spending, you really have to look at the labor market conditions there. And there, we've added jobs within our district since the cyclical trough in April 2020, but we are way below pre-pandemic levels. If you think about it, the district lost about 2.8 million jobs as a result of the pandemic. We've gotten back about a little less than 2.5 million of those jobs. I mean, to put it in percentage terms, we've gotten back 86.4% of the jobs lost across the district. Now, New Jersey and Puerto Rico have done better than the average. New York and the Virgin Islands have had a tough time. New York, in particular, we'll see there are a variety of reasons for that. And a lot of it has to do with the fact that so much of employment in our area is concentrated in service-producing industries. And you can see this in the right-hand side panel here, whether it's education, the health, or leisure and hospitality. Other areas that have had a tough time in our area are wholesale trade, where the job gains are about 2/3 of the jobs lost. And the same thing with the financial industry segment. And conditions vary widely when you drill into the weeds of our district. For the whole of the FHLBNY area, we've gotten about 86% of the jobs lost back. That's way below the national level, which is about 97.5. And when you look within these reports, within the specific areas, I mean, there are certain areas. I mean, it's almost like the old saying that all politics is local. Well, all economies are local. If you look at these numbers that we have in hand here, you can see that the job recoveries have been very different, dramatically different across the district. I mean, you have areas such as Puerto Rico, Atlantic City, Camden, New Jersey, Ocean City, that actually they've got employment levels now that are well above where they were when the business cycle turned. Whereas New York continues to struggle. We've only gotten back about 4/5 of jobs lost. And New York City in particular is lagging way behind the national average, whereas some upstate areas have done better. Turning to the housing market, this is something that's near and dear to our hearts. Basically, it looks like we are getting some relief in the recent pullback in mortgage interest rates. If you think about it, from the end of last year, whether it's for adjustable rate loans or fixed rate loans, we're up by almost 2 full percentage points, and that's been a tremendous drag on housing activity, both in our area and nationwide. Essentially what's happened is we had a problem with home purchase mortgage applications before the backup in interest rates because of limited inventory. That was a supply side issue, and now the higher mortgage rates have created a demand side issue and reining in demand. Looking nationwide, we're probably going to see further declines in existing home sales or closings in the upcoming report, given what pending home sales are doing. And we're probably going to see, we've been able to do pretty well in the recent environment over the past several months, because at least in New York and New Jersey, pending home sales have been running above closings. But it looks like they're pretty much in line right now. So it's going to be tougher to do better than the nation as a whole over the balance of this year. Against that backdrop, however, we still have very limited supplies of homes across New York and New Jersey. We just started to move off historic lows. We probably will see further improvements in the months ahead as more units that are under construction come on stream, and that's probably going to prop up median selling prices for some time. At least the latest data showed that we ebbed a little bit in New York and New Jersey, but I think you've got to be careful in drawing conclusions from 1 month's report. Looking at things nationwide, it looks like we have some significant relief on the price front. Although prices nationwide were up about 17.25% through the 12 months ended June, you can see on the left-hand side of the panel here, at least, that the pace of growth has dramatically slowed in the last few months. And again, the first step in reining in excessive home prices is the pace of growth has to slow, then stabilize, and then it's a coin toss as to whether or not prices actually retreat to where they were. But if you look at the affordability issue nationwide, affordability has been a massive problem. And not just because of home prices, but also because of interest rates. But if you think about it, as of the latest data available, nationwide, about 36% of the median family income was going to pay mortgages and housing costs. So the affordability, it's at its worst levels since the early 1980s. Now, turning to the supply side, where I think there's a tremendous amount of relief in store over the next coming several months, the number of housing units under construction nationwide were at an all-time high in the month of June. Nationwide, it's pretty much an equal split between single-family and multifamily units under construction. Within our area, and this is primarily New York and New Jersey, the Northeast, the number of units under construction, we're at levels we haven't seen since the late 80s. But in our area, and I think you can even see this visually when you go driving through our area, there's a boatload of multifamily structures that have yet to be completed and have yet to come on stream. You can see that in the right-hand side panel here, that whereas single-family homes under construction are still relatively low to where they were over the past several decades, multifamily housing has been really strong. As far as what builders are seeing, builders are becoming much more guarded in their assessments of market conditions. The housing market index remains in positive territory, and that's on the left-hand side of the panel here. These figures are from the National Association of Builders. So in general, they think the conditions are better than normal. However, there has been a deterioration in prospective buyer traffic and what they expect single-family home sales to be in the months ahead. And it's been across the whole economy. This has happened, regardless of what region you consider. Builders are much more cautious about the environment they're operating in now. If you look at the apartment market specifically, the apartment market demand is the markets remain tight. We can see that here on the left-hand side panel from data compiled from the National Multifamily Housing Council. Their market tightness barometer is still above the 50-point mark. However, because of higher interest rates and higher prices, sales volume collapsed in the second quarter. And against this backdrop, primarily because of higher interest rates, and you see this in the right-hand side panel here, they're having a tougher time financing projects. In fact, debt financing. Their debt financing index is at its weakest level since they started the survey, and the equity financing measure is at levels we haven't seen since the beginning of the last recession. While that's what builders are seeing, if you look at apartment rents across the country and within our district, they're absolutely on fire. Pretty much across most areas, monthly apartment rents are above their pre-pandemic levels, and for the most part, most areas in our coverage area are reporting double-digit year-on-year gains, and we're doing generally better in our area than the nationwide. Nationwide apartment rents are up about 12.5% over the 12 months ended July. New York and New Jersey are at 17 and 15.5% respectively. You have some areas where things are doing even better if you get into the more detailed data. For example, in the New York, Newark, and Jersey City area, rents are up almost 18% over the latest 12 months. Looking at it another way, looking at basically across cities, you can see again the same picture. That with the exception of Watertown and Yonkers in New York State, rents are going up at double-digit rates. Pretty much it's the same story in New Jersey, which is in the right-hand side panel there. In some areas like West New York, Jersey City, you've got rents that are rising at over 25% on a year-over-year basis. Despite the pullback in housing demand as far as the mortgage performance is concerned, mortgage performance continues to improve, and we can see that in the left-hand side panel here. So there's not much of a problem there right now, at least, as given the high employment levels that we have, and also the number of people that had loans in forbearance. They've gotten dramatically lower. We've gone from about a little over 8.5% at the pandemic peak to just 0.8%, and the absolute number of loans in forbearance has fallen from 4.3 million down to about a little over 400,000. Turning to commercial real estate, and this is you've got to be careful when you discuss commercial real estate across our district. You really have to be careful about what segment you're talking about, because we really do have a tale of three separate markets. The office market is still very weak across pretty much most of the areas that we cover. The industrial market, in contrast, is on fire, and the shopping center is mixed. What these numbers are in this table here, these are changes from the fourth quarter of 2019, before the pandemic struck. And you can see, at least in the office market, when you consider net absorption in Manhattan, there's about 35 million square feet that have come on stream since the pandemic struck. And vacancy rates, and these are changes, have generally gone up by over 10%. Then you've got the opposite in the industrial markets. Industrial market net absorption has been positive across every major area within our district. And if you look at vacancy rates, they are all lower. And with the exception of Binghamton, New York, all are reporting big increases in asking rents. The data on shopping centers is decidedly mixed. Looking at New York and New York City specifically, you can see these accumulative numbers in this right-hand side chart here on net absorption. The upper right-hand panel, that actually shows the absolute vacancy rates. So across downtown, midtown, and midtown south, all the vacancy rates are above 20%. Now, the price numbers really haven't moved that much lower. I think a lot of that has to do with the fact that you've got to wait for structures to come off lease. Turning to the office market, as I said before, office net absorption of industrial space has been extremely strong. The interesting thing is that when you look into the numbers, the actual numbers, New Jersey markets have accounted for about 2/3 of the industrial space taken down since the end of 2019. Against that backdrop, we've seen vacancy rates fall, and for the most part, asking rents have moved higher. This is one last chart that I'll leave you with, and this is basically a projector of future non-residential investment. The Dodge Momentum Index, which gauges the number of commercial and industrial building plans entering the planning phase, those numbers are trending higher, and we have seen a pretty dramatic pickup in the number of projects over $100 million or more. As of the month of June, we're top 25, so we're almost more than double the average of the previous 3 years at about 13 projects. So we still have a non-residential investment. Knock on wood that we don't go into a severe business cycle downturn, should be a contributor to GDP growth over the next 12 to 18 months. And with that, I'll pass it back to Tom to see if you guys have any questions.
Hey, thanks, Brian. A lot of great information. There are a couple of questions. This first, there was a few questions. I'm going to kind of wrap it up in one or two questions. The questions refer to the 2 consecutive quarters of negative growth. When was the last time that we had 2 consecutive quarters of negative growth that was not deemed to be a recession? And then also, dovetailing with that question, when did the U.S. start using the National Bureau of Economic Research to determine if we are in a recession?
Well, it's been rare that we have not had a recession called with 2 consecutive quarters of growth, but the magnitude of the downturn has generally been far larger than that which we've experienced right now. I mean, if you're fair about it, remember, these numbers are annualized. So the actual decline in real activity in the first quarter was about 0.4%, second quarter about 0.2%. There have been periods when we've had just one quarter of negative activity, and the NBER has called a business cycle turning point. So again, the other thing you got to be real careful with over the last 2 quarters is that the weakness in real GDP has been entirely attributable to the markup in inflation that we've experienced. If you look at nominal GDP in the first quarter, it was up 6.6%. Second quarter, 7.8%. So it wasn't as if actual spending collapsed. It was that basically people were paying a lot more money to buy the same amount of goods and services that they did the prior quarter. that's why I think you've got to go with the broader definition of what determines a recession. Basically, it goes back to I think it was Martin Feldstein. That would have been in I think the 70s, where the National Bureau of Economic Research became the arbiters of business cycle turning points. And they've been left alone to determine whether or not we're in a recession. To when they feel that they should get together and convene the business cycle dating committee. I mean, again, I think you really want to look at that smooth recession probability measure, because if you think about it, we know what the four series are. They're payrolls, industrial production, real income less transfer payments, and real manufacturing and trade sales. We can monitor those on a monthly basis. So to be fair, before the NBER got together and called the turn that said the recession was over, I mean, we had talked about this months in advance before those guys got together, and it was basically all you had to do was use that St. Louis model.
All right. Thanks, Brian, for that. This other question is kind of interesting and something I think about often as well. How does this situation that we're in right now with a very high level of inflation kind of relate back to what happened in the early 1980s, 1980, 81? I know the rates were extremely high back then, and the Fed funds rate got very high at that point, way higher than where we're at right now. So how do the two compare, and can we expect to see, or is there a probability that Fed funds rate could dramatically increase from where it is today?
Well, that earlier period was basically a true, monetary policy generated period of inflation. We had explosive money supply growth. There were things that made matters worse, such as oil embargoes and things like that. But basically, that inflation was attributable to tremendously lax monetary policy under the eye of Arthur Burns at the Federal Reserve. Could we have another flare-up in rates to where we were back then? Probably not, because you have to remember that back then, when Paul Volcker took the reins of the Federal Reserve amidst that inflation problem, the Fed decided on a Saturday evening to stop targeting the federal funds rate. Okay, most of us that have been around long enough, it's referred to as the Saturday night special. Basically, the Fed came out Monday and told everybody that henceforth and forthwith, we are no longer targeting the federal funds rate. We're targeting the money supply. And basically, the way you get at the money supply is you target non-borrowed reserves. So remember, you can control either the quantity of something or its price. You can't control both. So what happened back then was the federal funds rate was left to its own devices. And in that environment, you would have settlement days when the funds rate could spike at 25 to 50%. Could we get higher federal funds rate than we are right now? Oh, sure, absolutely. I mean, if you think about it, 2.5%, that's what even Fed officials consider neutral. And if you're trying to rein in inflation and rein in demand, you want to get restrictive. So we've got some ways to go. But do I think we're looking at an environment that we were operating in back then? No, because the operating regime is different. The Fed back then, they funds rate wasn't on their radar screen once they made that change.
All right, thanks, Brian. One last question, and we'll be done. We've passed the 11:45 mark, but this last question has to do with housing pricing. I'm coming out of such a low-rate environment. Now we're seemingly going to be in a much higher rate environment for the foreseeable future, unless we head into a recession. Do you think that housing prices, especially with the lack of inventory in the marketplace, do you think we're in a situation where, at least in the foreseeable future, prices will remain elevated and at the high levels they're at now?
Yeah, I think they will continue to grow. The first step is that the pace of growth will slow, and we've already seen that. So even though on a year-over-year basis, the pace of growth has come down, the sequential growth continues. You can see that in the monthly measures where we're up a little over 1% on things like the Case-Shiller measure. I think what you'll see as this goes on is you'll continue to see slower sequential growth in home prices. Now, whether or not they reverse out is probably a function of, if we do have a recession, how deep it is, and also how quickly the the supply comes on stream. Because I mean, when you look at those numbers, we've got historic levels of housing units that we just haven't been able to finish for a variety of reasons. Builders complain that they still can't get building materials. I don't know if anybody's tried to order a major appliance in the last several months, but there are significant lags in trying to get things like refrigerators and dishwashers. So, I mean, you kind of have a pig in a python thing here. And when this stuff does come on stream, that's going to be an added thing that holds down home prices and residential rents.
All right. Thanks, Brian. Appreciate all the great insights today. Thank you, everyone, for attending. We're gonna wrap up the webinar now, and we'll see you next time. Appreciate everyone's participation, and thanks again, Brian.
Thank you.